What up, folks? We ready to get back to it? Well, welcome back to the Gauntlet. Consists of the US dollar, the 10-year yield of the US dollar, and then the 10-year yield of the Japanese yen. We don't really follow the yen, but the 10-year yield of the yen, because it's important of where it's positioned. And then the volatility index for the stock market, and then the fear and greed index for the stock market, and then the fear and greed index for the crypto market creates our gauntlet. We want to see the timestamp before the market opens, and then we go week by week to see how it fluctuates. Very important, because without the price, you have nothing, right? We don't trade these things. They're measuring tools, but they allow you to understand how price fluctuates. It's good to do that with something that you're not trading. You won't be emotional about it, because it's emotion, right, that causes loss. Trading is life, and life is trading. Emotion wrecks you in life, and it'll also wreck you in trading. And we're all created equal, so we all get to go through these types of things, right? If not, you're lucky. So let's start with the dollar. And a few videos ago, I did an extensive talk about the dollar. Then we'll do an extensive talk about the 10-year, and then an extensive talk about the VIX. And of course, the fear and greed. So on the 10-year, we're using the basic scale of 100. We see that the premium is 110. The midpoint is 100, the point of interest, right? And then 90 is the discount. And you see, as we are positioned right now, the daily chart, it's hovering at 100. It can go a little bit below, it can go a little bit above, a little bit below, that's fine. Right? That's what gets everybody in trouble. They don't have the basic scale of 100. They don't know that 100 is really the point of interest. You got to go below. Like if you're going to buy it, we're not going to buy it, but if you were, you want to buy it at a discounted rate. 96.50, 94, 91.50, and 90 down there. If you're going to sell it, you need it at 108.50. 110, 111, up there. That's where you're supposed to sell. The market makers will always bring you to the middle of the structure, daring you to do a buy or a sell in the middle of the structure. I won't spend too much time on that because we got to get to everything else. But that's the price, right? So you see how it fluctuates. Now, on the 10-year, you're dealing with a percentage, 4%. We don't want, 4% is a buying position. For the 4 is a buy. 6, 5, 4. 6 is the premium, 5 is the middle, and 4 is the discount. We could buy from the 4. It's starting to elevate off the 4. Well, what if it's not 4? What if it goes down and drops below 4? Then it's going to 1.5. Down there. See? If it's going up from 4, which it looks like it is, it's heading to the 6. 4 is the discount, 5 is the middle, 6 is the premium. What if it gets above 6 and it's going 6.5, 7.5, 8.5, up towards 10%? It just is what it is. We don't have to sugarcoat nothing. The numbers are the numbers. The scale is the scale. We don't have to be emotional about none of this. The facts are the facts. We all get to pull up these charts and look at the same numbers. Oh, we're cutting the interest rates. Well, okay, if we're cutting the interest rates, then why are the interest rates going up? One point is that the Federal Reserve don't control the 10-year, the 30-year. They only control the 1 year and the monthlies. The Fed controls short-term interest rates. They don't control the long-term. That's why when we say we're cutting interest rates, that the rates that we're really wanting to know about are going opposite of what the Fed is talking about. You need someone to present this to you so you understand what the truth is. Interest rates have been too high for too long, and they look like they're going up even further. The 10-year yield is the cost to borrow dollars, and it's going up. It's going to be more expensive to borrow dollars that are less expensive because the dollars are losing 10% of value every year, yet they charge you more to borrow them. It is a scheme, and hopefully you're protecting yourself. So that's the 10-year for the U.S. dollar. The Japanese 10-year is at 2%, down towards 1.5. It's not at 1.5, though, you see. It's in the middle. It's at 2.5 because it's 3.5, 2.5, 1.5. No matter what, this is across the map, across the globe. Any financial institution knows how to play this game. And it's the slaves who don't understand. When they're dealing with the higher interest rate, a lower interest rate, they don't know the scale. So I'm obviously presenting you the scale so you can understand where you're at within the scale so you can take advantage of the scale. Now, if the 10-year for the Japan yen keeps going up, where is it going? From 1.5 to 2.5 to 3.5. And then it's going to make a decision once it gets to the 3.5. Is it going to come back to 2.5 and then go through 3.5, go to 4%, then 5, and then 6? Because that's how it moves. It doesn't matter which way it goes. It's going to follow the scale as the scale is presented. All right, so where I really wanted to be was the VIX. The volatility index for the S&P 500, the breadth of the stock market. We see that we're hovering down towards the bottom. What's the bottom? 15, right? 15, 25, 35. 15 is the discount. It has, from history, from what I understand, it doesn't really go to 10%. It stays around 15, 14, maybe 13.5, right? And then it spikes. Whenever the VIX spikes, the market crashes, if that's what we want to call it, crash. I call it dips. It's not really a crash. Crash means it's going to go down there and stay down there. We understand that we need to be buying the market when the market falls because it's not going to stay down there long because the rich will always, well, let's say the greedy will always be greedy. Whenever the market, we'll call it capitulation. Whenever the market capitulates, what's the last capitulation we had? In the tariff scare, when Trump said, 100% tariffs, or however much the tariffs were, the market dipped in April and then went to all-time highs right after that. So understand that, right? Whenever the market dips like that, you have to have money ready to go so that you can, what's called, buy the dip. And this VIX will spike up towards 50 and 60%. We go from 15, 25, 35, get above 35, and then go 40, 50, 60 up there, right? Because you see what it did before. It went up there and came right back down. It can't stay up there. This is a volatility reference. It's a temperature check. You want to see when the volatility index goes up towards 60, 70, 80%, and then it'll go right in and come right out. It don't feel like that's what's happening, but if you look at the history of the VIX, that's what it does. It does that spike and then comes back down. Whenever the VIX is down low, the market is going to all-time highs. Whenever the VIX spikes up, we get a scare. All right, so fear and greed index, the stock market is in greed. It's a measurement of the dumb money, of the sentiment of dumb money. When it's greed, you should be looking towards selling. When it's fear, you should be looking towards buying. And the same thing with the crypto. But the crypto has a little chart down there. And that's a good chart to see. I wish this fear and greed for the stock market had the chart, but we don't need that. We just need it for crypto, where it can tell you what it looks like down at extreme fear with the actual chart with it. So shout out to the people. Shout out to Activity. Keeping this under 10 minutes as much as I can, right? For the people, not the profits. It's the consistency and persistency that wins in the market. To beat the market, you must become the market. And the market moves with integrity through its price. You have to know the price to have integrity on price. And if you don't have the knowledge of the price, you have a tendency to get wrecked. Nobody else is teaching this. That's what makes this channel so special. So let's get to it. Good luck. We shouldn't need luck, right? When you have the facts and the truth, luck is not really a part of it anymore. So let's get to it. Hey.